Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. Is the most popular plant-based food company a good investment? In this video, we will be analyzing if Beyond Meat stock is a buy. Can Beyond Meat, stock ticker symbol BYND, mount a miraculous turnaround? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Beyond Meat. Beyond Meat was founded in 2009 by Ethan Brown, with a mission to create plant-based meat directly from plants, offering sustainable and ethical alternatives to traditional animal-based products. The company's core offerings include a variety of plant-based beef, pork, and poultry substitutes, all designed to replicate the taste and texture of conventional meat. These products aim to appeal to a broad audience, including vegetarians, vegans, and meat eaters looking to reduce their environmental impact or improve their health. With approximately 750 employees, Beyond Meat is headquartered in El Segundo, California. Now let's look at the price action. Starting with the one-year chart, we see that Beyond Meat had a CAGR of about minus 49%. Zooming out to the 5-year chart, we see that Beyond Meat had a CAGR of minus 52%. Beyond Meat has been a big loser over the past year, but has been just as big of a loser since going public. This company is not very good. Now let's hop over to market share and take a look at Beyond Meat's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under food and see that Beyond Meat is categorized as a packaged food company. Expanding the packaged food tab, we can see that Beyond Meat has the second smallest market share of the companies in this category. But the bright red color indicates that the company has the worst market share growth. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Beyond Meat, BYND, and see that the market share is just 0.04% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Beyond Meat commands a minuscule portion of food spend. The 5-year market share CAGR for Beyond Meat is minus 14.3%. This means that Beyond Meat has lost significant market share over the past 5 years. If we start in 2021, we see that the market share was 0.06%, 0.05% in 2022, 0.04% in 2023, 0.04% in 2024, and 0.04% over the trailing 12 months. Though the decline has slowed, Beyond Meat has consistently been destroying their market share over the past 5 years. Let's take a look at the fundamentals to learn more. Gross margin is 12%. This is a drastic improvement from when the company has negative gross margins. Revenue has compounded at around minus 11% over the past 5 years and has fallen to $320 million most recently. Clearly, sales have been diminishing for a long time, which is bad news for the business and investors alike. When we look at cash flow, we see over the last 5 years that operating cash flow has improved at a 30% CAGR, CapEx has improved at a 50% CAGR. As a result, free cash flow has also improved at a 35% CAGR during this time period. While improvement is good, the company is still burning a little over $100 million every year. How long will they be able to keep this fire ablaze? Weighted average shares outstanding have increased over the last 5 years, going from 63.2 million shares in 2021 to 68.9 million shares most recently. Beyond Meat has been very diligently diluting shareholders. Not only are shareholders invested in a poorly performing company, but that very company is vaporizing the amount of the company shareholders own at a rate of about 3% per year. This is the inverse of compounding. Now let's view return on invested capital. Return on invested capital has actually improved from minus 39.6% in 2021 to minus 30.7% most recently. With this value being negative, it means that Beyond Meat is not profitable and there has been no return on investments made in the company. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage, as well as inventory control, going from 175 days in 2021 to 109 days most recently. Beyond Meat has actually gotten more efficient over time. Still, the benefit here pales in comparison to the horrible metric. Now, let's look at Beyond Meat debt. A net debt to EBITDA has decreased over time, going from minus 3.1 in 2021 to minus 8.8 most recently. Given that the company is unprofitable, This value means that their debt is mounting. Last, let's compare performance to the benchmark. If we perform a backtest comparison of investing $10,000 in Beyond Meat versus the S&P 500, we find some very poor results for Beyond Meat. In that comparison with the S&P 500, $10,000 invested in Beyond Meat would have shrunk to $388 versus $19,823 if invested in the S&P 500. This is an annualized return of minus 45.12% for Beyond Meat versus 13.46% for the S&P 500. A Beyond Meat investment would have been much more volatile with a 78.28% standard deviation versus 17.90% for the S&P 500. Beyond Meat outperformed the S&P 500 in terms of the best year performance, for which Beyond Meat grew 65.34% versus the S&P 500's 28.74%, and underperformed the worst year performance, where Beyond Meat fell 81.11% versus the S&P 500's 18.17% fall. In terms of max drawdown, Beyond Meat fell 98.61%, significantly more than the max drawdown of 23.93% for the S&P 500. Beyond Meat also massively underperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. The Sharpe ratio for Beyond Meat was minus 0.41 versus 0.65 for the S&P 500, and the Sortino ratio was minus 0.60 versus 1.02 for the S&P 500. Beyond Meat has been a terrible investment and has been trailing the S&P 500 for a long time by nearly every metric. There are few publicly traded food companies as bad as Beyond Meat. In any event, is it a buy? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Beyond Meat. It is a food company with a gross margin of 12%. The 5-year revenue per share CAGR is minus 13%, and the 5-year free cash flow per share CAGR is 36%. The gross margin is actually decent, and improving free cash flow is a good thing. But continued decline in revenue per share spells trouble. A return on invested capital of minus 31% is horrible. Next, the cash conversion cycle of 109 days is better than it's been, but is still very high. Concerning debt, a net debt to EBITDA of minus 8.8 means that Beyond Meat is still unprofitable and has massive amounts of debt. So from a fundamental standpoint, Beyond Meat is very, very bad. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, cannot be calculated because Beyond Meat is unprofitable. This company burst onto the scene promising to revolutionize how we eat, and for a while, it seemed like they were well on their way. Beyond Meat's core strength lies in its brand awareness and marketing. They've been strategic with partnerships, getting their products into major fast food chains and retailers, which initially fueled significant growth and brand recognition. Their mission of sustainability also resonates with a growing segment of environmentally conscious consumers. However, Beyond Meat has faced significant challenges. The initial novelty has worn off, and consumer demand for plant-based meat products has declined, particularly with ongoing macroeconomic pressures like inflation, which make their often premium-priced products a tougher sell compared to traditional meat. Competition has also intensified dramatically, with established food giants and numerous startups entering the plant-based space. Financially, the company has struggled with being consistently unprofitable, reporting net losses, and dealing with a substantial debt load. So what's the outlook for Beyond Meat? The company faces an uphill battle to regain its footing. Looking at 3 key metrics highlights the enormity of the challenge. Debt has risen over time and now sits at $1.2 billion. Meanwhile, their cash position is $102 million, while their burn rate is $108 million per year. Beyond Meat has less than 1 year of runway, and they will need to raise cash again, either with a secondary share offering, diluting shareholders again, or by taking on more debt. Both options are terrible, and it might be time for the board to explore a sale of the company. I don't see the company surviving if they are not acquired. Overall, I give this company a 2 out of 10 using my proprietary scoring system. Clearly, I am not bullish on Beyond Meat. If you do own it, good luck. Many thanks for watching. What do you think about Beyond Meat? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.